please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite our market master for the morning, Neelkanth Mishra, Managing Director and India Equity Strategist of Credit Suisse, joins us. Good morning, Neelkanth. I read both your tax note as well as your GDP note. But for the benefit of viewers, you're not terribly impressed by the 8.2% GDP number?
No, it is a very strong sign. This is what we wrote as well, that the disruptions are now firmly behind us. But the number itself shouldn't be, we shouldn't take that as a very strong indicator of growth. And this is something that we said when we analyzed the first quarter, that is the June quarter results for companies as well, that there was a very weak base. So if you remember the period running up to the GST, the start of GST, there was significant inventory reduction in the economy, and therefore manufacturing, if you combine mining, manufacturing and construction, that is, so the industrial growth was only 0.1% in the June quarter last year. So the fact that it grew at 10.3% this year is therefore not surprising. On a 2-year CAGR basis, the growth is actually quite average, I would say, on the industrial side, below average. On overall GDP, what is quite remarkable is that in the last 5 quarters, where we have seen first disruption and then a stronger growth on that disrupted base, the 2-year CAGR is between 6.8 to 7%. It's almost like a flat line. So trend growth is continuing. If you remember, our 25-year CAGR is also 7%. So we are very much at trend growth. We are definitely not overheating from a CPI perspective, but what worries me quite a bit is that even at this growth, we are now running a balance of payment deficit, and therefore even this growth appears unsustainable and has to slow down.
Neelkanth, good morning. So there's a bit of a dichotomy here, right? There is this growth issue, crude at close to 80, rupee at where it is. Still, the market's at new all-time high, and in fact keeps making new highs. Your thoughts on whether we are perhaps creating some risks here?
Not really. See, we have to understand that the economy and the market have very different constituents. So as we've often said, more than half the revenues in the Nifty and the BSE 100 are not denominated in rupees. In fact, if the USD INR assumptions for the overall market move from, say, 64, they may have been about 6-7 months back, to say 71 or say a 72, 73 going forward, that by itself could actually drive Nifty EPS higher by 8-10%. So, there are refiners, there are metal companies, of course there are IT companies, there are other companies with foreign businesses and assets, and therefore the weakness of the rupee, and in fact we've done a quite detailed analysis on this. So other than the fact that around rupee weakness, some foreign investors may try to preempt it and sell out and hope that they'll come in when the rupee has weakened to prevent the losses from rupee depreciation. Once you ignore that aspect, actually a year from a very meaningful rupee fall, the Nifty is generally meaningfully higher. So I don't think the external balance by itself is something that, or rather the rupee itself, should be a concern on overall Nifty. For the foreign investors as well, given that other emerging markets have actually had much weaker currencies, this is not necessarily a bad market to persist with. In terms of the balance of payment deficit, though, that's something that worries me. It's almost like a household that is consuming 130 rupees but has income of only 100 rupees, which is a 30 rupees of current account deficit. And now even foreign lending is not available. That is, foreign capital is not available, which is that foreign capital inflows are short of 30 rupees. And therefore, say they're only 20 rupees, and therefore you have to cut consumption by 10 rupees, and which is the process that now has started. I think as the rupee weakens and as it translates into, say, higher prices of autos, higher prices of consumer staples, you will see demand starting to slow down. We have started to see some signs of that. It is still distorted by seasonality of festivals and and some other factors. But I think as that correction starts to happen, you may see that some of the more overvalued stocks, especially in sectors where the consumption growth will slow, may actually get negatively impacted. But overall, Nifty, I don't see a concern.
Okay, so consumption stocks could perhaps see a slowdown. Neelkanth, hi, good morning. What are the what is your analysis suggesting in terms of lead indicators? Because what we hear from companies is that construction activity has picked up, infrastructure projects are looking, execution has picked up compared to what we've seen before. Now, the commercial vehicle sales indicate that even the tipper segment is doing very well, directly related to construction activity. What is your own analysis suggesting?
Yeah, so construction is a sector that we've been positive on for almost 2 years now. We think that there is a lot of government money going in there, especially on the road side. We have seen some remarkable pace of activity. I mean, it was surprising to us how rapidly the Mumbai-Nagpur, that prosperity corridor expressway got ordered out and construction started. And there is more than 2 trillion rupees of projects happening in Mumbai itself. There are 15 plus cities doing metro rail. A lot of this is actually has extra budgetary funding, so it is not necessarily state and central government budgets, where the spending growth is not that meaningful. So clearly there is, and the Mumbai-Vadodara Expressway, so there's a lot of work that has been kicked off, and therefore it's not surprising. They are very positive construction companies. The challenge, of course, is that on the consumption side, so when you're looking at overall GP growth, that is where our worry should be, and especially because of the valuations that we see in some of those sectors.
Okay, by the way, those are Bajaj Auto's numbers and they're looking very good, much better than street estimates for sure. The Nomura estimate was 4.16 lakhs. It's come in at 4.37 lakhs, which is a 30% growth. It's the highest ever monthly sales that the company has posted. And this, look at that graph. For many months now, they've been stuck in that range of, 4 lakh to 4.15 lakhs. Now it's suddenly gone above that. The big kicker really, if you look at it, the domestic sales this month have come in at about 2.38, I think. Okay, wait, domestic sales are 2.55, which is a 27% growth that you're seeing in domestic sales. This compares to 2.37 last month. So there's a good pickup that you're seeing in the domestic sales. And exports also, the clip is very strong in exports. 35% growth in exports at 1.81 lakh units. That compares to 1.62 in July and 1.69 in June. So both domestic and exports are firing on all
export number is what the market would like more, because, for Bajaj Auto, that is where the key issue is. And for domestic, you could have said, but that because of insurance norm, there was that perhaps extra fillip. But the export number really is something that I think the street would like. Last quarter's numbers, you saw that big derating in Bajaj Auto.
Yes, in fact, when Rajiv Bajaj spoke to us in July last month, he had told us that from October onwards, the run rate will pick up to 4.5 lakh units. So we're getting to that. I mean, one would have wondered from 4 lakh, how would you just jump to 4.5 lakhs?
But there is clearly
a steady pickup that you're seeing.
Absolutely, absolutely. Okay, well, to come back to you, Neelkanth, I remember your previous note where you said that the best growth is behind us. So, what are you looking at? The rupee depreciation has a positive impact on the Nifty, as you pointed out, and on many Nifty company earnings. So how are you looking at the earnings in FY19 and 20 now with the renewed parameters?
So the consensus numbers for FY19 are at about 31, the last I saw, and FY20 were about 24. So the FY20 over FY18 growth is about 57%. So it looks quite high. But then you have to understand that FY18 saw very large provisions made by banks, and therefore the earnings at a headline level were sort of subdued. They were actually negative 4-5%. So once you adjust for that, I think these numbers are quite achievable. There are segments, as we've discussed, where I think growth will slow, and in particular on that release, the concurrent indicators actually have been very strong. In fact, if you see corporate commentary, even after the first quarter results, the commentary is very positive. So I don't think there's anything wrong with what is happening right now.
Okay.
What we have to worry about And that is what, as market participants, we have to worry about, is what happens going forward.
Fair point. Neelkanth, as a house, Credit Suisse got that bottom on metal stocks bang on. What's the call now? Where are we in terms of cycle? Because if you look at stock prices, while they've moved up from the recent lows, they're still way off their highs.
Absolutely. So, so we are in the midst of very significant global risk aversion. So, our Credit Suisse Global Risk Appetite Index is still in panic territory. It doesn't look like it when you look at the Indian market, but if you look at how global asset classes are trading, there is significant risk aversion. There is the equity-only risk appetite is actually at -7. So, the lowest, I would say, in 15 years. So there is, I think, a lack of certainty around all the issues around the trade war. I mean, what will happen with U.S. fisc boosting up yields and forcing the Fed to raise rates, and therefore creating more pressure on emerging markets, which were heavily benefiting from the inflows because of the zero interest rate policy and the QE policies of the Fed over the past 7-8 years. As the reversal happens, how badly will growth slow down? Will there be a crisis? What's happening in China? When is Chinese growth going to revive? Well, there is a meaningful amount of uncertainty there, and therefore I think metals is a sector which is very greatly determined by what's happening and the expectations around China. Our own view is that there was a growth dip, and since then there is also a revival. Last month's data was actually somewhat encouraging, and as the policy starts to support growth again, that some of those fears of a very sharp slowdown will abate, and so we have seen the stocks bounce back a bit. What is also happening is that as the evidence of undersupply, especially in sectors like steel, is now becoming stronger. So now we are in the 16th, 17th month of very elevated spreads between steel prices and iron ore and coking coal prices. So that is the profitability on these steel companies operate, and that has been so strong, and yet there has not been enough of a supply response outside of China, and which suggests that this number needs to rise higher. I mean, there are some steel stocks, some leading steel stocks in India, which on current profitability are at 20% free cash flow yield. So generally, as the profitability improves, the P multiple, the EV/EBITDA multiples correct. So that correction is also happening. So we are also cutting down our target EV/EBITDA multiples, but the profit improvement, the cash flow generation is still tremendous. And so as the comfort comes around, I think these stocks would still do well. They're also rupee beneficiaries, as
of course, yes, in a big way.
A weaker rupee beneficiary.
Yes, would have loved to ask you a lot more, Neelkanth, but we have another guest waiting by. Thank you very much indeed for joining us and putting those fears on the table, the current account deficit, and probably even